93 years ago, the stock market crash was the first key factor that brought about the Great Depression. The crisis led to bank failures, widespread unemployment, and a drop in housing prices. Many businesses, homes, and farms were lost as a result. A period of prolonged economic stagnation followed that lasted until the outbreak of World War II in 1939. Today, it could be a global debt of over $305 trillion, according to the Institute of International Finance, IIF, that causes the next financial crisis. As you probably know, there are several common factors that led to the Great Depression: overproduction, missteps by the Federal Reserve, greed from wealthy elite, example, stockbrokers, a constrained presidential response, and an ill-timed tariff. These are universal issues that have plagued every society throughout history. They're not exclusive to any one era or region of the world. There are many people who believe that another Great Depression is imminent, not just possible but likely, within our lifetime. One of such predictions has been coming from the ITR Economics, as they have been forecasting that a second Great Depression would happen in the 2030s. This is Savvy Economists, and in this video, we're going to discuss why the coming financial crisis that will be worse than the Great Depression. Please watch, like, and share this video. Drop your comments and observations below and subscribe to the channel for more videos like this. Let's dive right in. After more than a decade of countries in the world escaping the last financial crisis that lasted for 18 months, 2007 to 2009, there seemed to be a coming crisis that would hit everyone so bad. With the current inflation looming most especially in Canada, US, and other largest European country, financial conditions are now becoming a major concern. Canada was among the countries that was not affected badly by the 2008 financial crisis, unlike top countries like the US, Portugal, Spain, Italy, and Ireland. According to a news post by National Bureau of Economic Research, NBER, Canada was able to not have a banking crisis then due to the way they regulated their banking system. They ensured that their banking system controlled banking investment and mortgage lending. But with time, all these began to fade away as the country began to face an economic downturn. The coronavirus pandemic also came and worsened the situation on ground. Here are reasons why the coming financial crisis will be worse than the Great Depression. Credit crunches. According to Investopedia, a credit crunch is a drop in lending activity by financial institutions caused by an unexpected shortage of funds. While financial crises are a natural part of the economic cycle, many of the recent ones have been triggered by credit crunches as money dried up. This happened during the Asian crisis of 1997 to 98, the Mexican crisis in 1994, and more recently the 2008 financial crisis. The trigger to the credit crunch could be some event that disrupts the normal flow of funds, for example, a natural disaster, political upheaval, or a change in interest rates. The Royal Bank of Canada, RBC, warned that Canada's economy could soon enter a recession and interest rates could fall to zero. In the last 2 years, the bank dropped interest rates twice in order to stimulate the country economy. Rising interest rates, according to some analysts, will precipitate the next financial catastrophe. This is likely to squeeze the availability of credit as interest rates rise and banks become more cautious about lending. Fallen housing prices and sales. After the economic crisis of 2008, many people are concerned about the value of their houses. U.S. housing prices fell by more than 30% after the collapse of the subprime mortgage market in 2007 to 2008, and they have been falling since 2011. Although Canada was able to quickly overcome the 2008 crisis, their housing prices and sales were still affected. Housing starts dropped by 118,000 from a 175,000 average. Existing home sales fell from their peak by 40%, and the national house resale and new home prices dropped by 9.5% and 3.5% respectively. In a bid to overcome the crisis then, the Bank of Canada lowered their interest rates and they began to experience an upsurge in housing price again. Unfortunately, the coronavirus pandemic came, and with time, the economy of many countries worldwide began to plummet. Canada experienced an extremely high increase in its home value, and in order to protect their economy from this situation, the Canadian government decided to increase its interest rate. But according to Desjardins Securities Inc., they predicted that with the current market decline, Canada homes could lose as much as a quarter of their value due to the increased interest rate. In many cities, the average price of a house has fallen below the original price of the house when it was bought. For example, Toronto recently reported a 3.9% decrease in its home price index. With prices falling even further and sales plummeting, this will have a devastating effect on the economy. Millions of homeowners will find themselves underwater on their mortgages and struggling to make ends meet. Many will be forced to sell their homes at a loss, further depressing prices and exacerbating the crisis. Excessive debt levels. If you have a clear memory about the 2008 financial crisis, you will remember that it was triggered by excessive borrowing. Similar has happened today in many countries, Canada, Australia, and other Western countries. In these places, the average household debt is more than 150% of their annual income, and the government debt is close to 80% of their GDP. This is the highest level of debt in the last 40 years. The chart below shows the Canada government debt, percent of GDP from 2012 to 2022. Source: CICdata.com. Lack of consumer confidence and overleveraging will cause problems too. It is important to note that the coming financial crisis will not be isolated to the banking sector. In fact, it could have a much broader impact on the economy, particularly if consumer and business confidence falls as a result of a deterioration in the financial sector. During the Great Depression, the American government had very little control over the country's economy. This was partly because the government did not have the tools, example, a central bank, that would allow it to stabilize the financial sector. High asset valuations. Investors in the stock market and real estate are expecting high returns on their investments. However, the earnings of most companies are not growing at the same pace as their stock prices. Sooner or later, investors realize that their expectations are unrealistic and that they will not achieve their desired rate of return. This kind of situation happened in 2000, 2003, and 2008 when the stock market fell by 50%. Experts believe that it is likely to happen again in the coming financial crisis. Conclusion: we are living in a world where our finances are constantly being affected by the global economy. This is why it is so important to pay attention to the financial news and to understand how you can affect your financial future. Many people have been living in the mentality that the market will always go up and that you should invest as much as you can in it. But the truth is, the market has its ups and downs, and if you don't know how to protect yourself, you could lose everything. The truth is that you have to know what's going on with the global economy and make your strategies accordingly. It's hard to predict the length and severity of future depressions. There are no guarantees that we won't experience a financial crisis greater than the Great Depression in the future. Kindly drop your comments and replies in the comment section, and don't hesitate to like and subscribe to our channel if you enjoyed the video. Thank you for watching.